Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 14th of November. I'm Daniel Lam, your host for the podcast. Today, we are moving away from equities and discussing Asian US dollar bonds. Now, the global corporate bond markets started strong in November after a dovish FOMC. In Asia, the rebound gathered steam after an investment-grade rated Chinese developer received public support from the Shenzhen municipal government. Now, we believe that this development should support risk-on sentiment in the near term, but on a 6 to 12-month horizon, we are staying neutral towards Asian US dollar bonds. Well, first of all, the government support to a single developer is arguably idiosyncratic and should not be confused with broader industrial policy measures. We believe the Shenzhen government's offer of support is based on Shenzhen state asset regulator indirectly owning around 30% of the concerned developer, and the concerned developer contributing over 30% of the annual revenue of Shenzhen's state asset regulator. Secondly, we continue to see support measures for the real estate sector tilting towards home buyers instead of developers. We believe developers may continue to struggle amid an imbalanced demand and supply outlook, thin liquidity, and limited refinancing channels. The Chinese real estate sector also contributes only around 2% of the Asian US dollar bond benchmark index after multiple defaults this year. So as such, we do not expect risk-seeking technical buying in the sector to trigger significant upside to the broader asset class. And lastly, despite defaults in the Chinese real estate sector, China remains the largest geographical contributor to the Asian US dollar bonds benchmark. As such, the Chinese economic outlook, which still appears to be weak, could weigh on the overall performance. So month to date, the rebound in Asian US dollar bonds has been lagging its developed market counterparts. Now, we continue to stress and believe that for both Chinese equities and bonds to rally on a sustainable manner, it is difficult to achieve without a decent recovery in economic data, which in turn would most likely need a reasonable amount of stimulus. Now, looking at the latest key macro data in China, which was the CPI announced last week, it dropped by 0.2% year-on-year last month, falling below consensus estimates of 0.1% year-on-year decrease. Threats of deflation is a headwind for corporate profits and the economy in general, and what is holding back both Chinese equities and bonds. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.